You are listening to Retirement Lifestyle Advocates Radio. I am your host, Dennis Tubbergen. I am here every week at this time. Glad you decided to listen in today. Hey, joining me on today's program, I have a terrific special guest. Joining me in the next segment will be best-selling author Harry Dent. Harry is a prolific author. Seems like every book he writes ends up on the bestseller list. And we will be talking to him about his forecast for where stocks are going and where the economy is going. That will be in segments 2 and 3 on today's program. You know, two good people can disagree, and Harry and I share a slightly different opinion on where gold is headed. In fact, this past week, subscribers to the Portfolio Watch newsletter got a forecast from me as to where the Dow Jones Industrial Average and where gold may go from here. Now, if you're not yet a subscriber to the Portfolio Watch newsletter, you really have no excuse because the newsletter is free. All you need to do to subscribe is go to the website retirementlifestyleadvocates.com and click on the featured resources link, and there will be a place that you can subscribe to the Portfolio Watch newsletter. It is delivered every week on Monday at 5 o'clock, and you will get just one email a week from us. You will not have your information shared. We give you the newsletter, and we give you a link to the podcast in case you missed this program at the time it airs in your area. Well, this past week in the Portfolio Watch newsletter, as I said, I made a forecast. So I'm going to share with you in this segment what that forecast is and why I'm making the forecast. And I'm going to provide you with some documentation as well. Now, if I were to say the Dow to gold ratio now stands at about 18, let me repeat that. If I were to say the Dow to gold ratio now stands at about 18, many of you would have no idea what I'm talking about. But it's an indicator that you should really pay attention to because as time goes on, in my view, it's going to become even more valid than it already is. Now, if you're not familiar with the Dow to gold ratio, it's something that I track every week in the Portfolio Watch newsletter, and it's calculated very simply. You simply take the price of the Dow Jones Industrial Average in dollars and divide by the price of gold per ounce in dollars. Now, the Dow, at the time that I made the forecast, was hovering around 27,000. Gold was at about 1,500, so if you take the 27,000 and divide by 1,500, you get a number of approximately 18, just under 18 actually. So the Dow to gold ratio is 18, meaning that if you were to use gold to buy the Dow, it would take about 18 ounces to buy the Dow. Again, the price of the Dow in dollars divided by the price of gold per ounce in dollars. Now, why would I want to use a ratio that has Dow over gold? Why would I want to price the Dow Jones Industrial Average in gold? And the reason, if you think about it, is pretty obvious. It's because dollars lose purchasing power over time. It's because inflation occurs over time. And inflation is really just dollar devaluation. So inflation, the same force that causes prices to go up at the grocery store, also drives up stock prices. So taking the Dow and dividing it by the price of gold per ounce gives us a real value of stocks as opposed to a nominal value. If the dollar over a long period of time were to lose 20% of its purchasing power, that would have the effect of driving the Dow up on a nominal basis by 20%. But not on a real basis because those dollars don't buy what they did when you initially invested in the Dow. An ounce of gold, on the other hand, has always been an ounce of gold. And since through most of history gold has been money, it's a very effective way to determine the real value of stocks. Now, as I said, the Dow to gold ratio now stands at about 18. And here's my forecast. My long-term forecast continues to be that this ratio will reach 1. Now, that means more downside for stocks and more upside for gold, likely. Now, that's a big move. It's at 18 now. So that means gold has to go to 10,000 and the Dow has to go to 10,000 to get a ratio of 1. Now, in my view, economic circumstances exist around the world, and they exist presently, currently. And these circumstances suggest that this is a likely outcome. Now, as crazy as that prediction might sound to you, hear me out. Much of the rally in stocks over the past couple years, just to get started, has been due to companies buying back the stock of their own companies. Now, CNN reported this on August 22. Corporate America's epic buyback mania may finally be ending. 2017 corporate tax cuts left U.S. businesses flush with cash. S&P 500 companies responded by rewarding shareholders with record amounts of buybacks in 2018, with each quarter setting an all-time high. However, that record-shattering pace appears to be slowing. S&P 500 companies executed $165.7 billion of buybacks during the second quarter of 2019, according to preliminary estimates by S&P Dow Jones Indices. And although that is still a large amount of repurchases, it's down 13% from the same period 1 year ago. The article continues by saying the slowdown in buybacks, which have become a lightning rod for criticism among some in Washington and even on Wall Street, underlines the impact the law had last year as companies steered a sizable chunk of their windfall to investors. Well, as stock buybacks slow, one of the activities that's been supporting the stock market becomes less supportive, and that makes stocks more susceptible to a decline. As demand slows, prices fall. As demand wanes, prices decline. The second thing that you want to take a look at is margin debt. Now, if you're not familiar with margin debt is debt that an investor incurs to purchase securities, usually stocks. Now, as long as margin debt keeps rising, what it means is people are continuing to borrow more each month and taking the loan proceeds and buying stock. And as long as people continue to borrow more each month to buy stocks, it helps create more demand for stocks. So given that we have very high margin debt levels, and given that we've had a significant amount of stock buybacks by corporations, we have a couple areas of demand that are now starting to slow. Now, there's more to this story, and I'll give you more insight into my forecast in the last segment of today's program. However, let me remind you that if you're just tuning in, you should be a subscriber to the Portfolio Watch newsletter. You would have received this forecast last week in your email inbox. If you'd like to subscribe, go to retirementlifestyleadvocates.com and click on the featured resources link. I'll be back after these words with Harry Dent. You are listening to RLA Radio. I'm your host, Dennis Tubbergen. Joining me again on today's program is one of my favorite guests, best-selling author, Mr. Harry Dent. Harry's most recent book is 0 Hour, and if you're not already a subscriber, Harry has a free newsletter that's available at harrydent.com. I would encourage you to check it out And Harry, welcome back to the program.
Yeah, nice to be back, Dennis.
So, Harry, tell me and the listeners, last time you were on, which was in the spring, we talked about the fact that you thought that the market would probably rally a bit here through this year, and it seems like that's what's happening. What do you see ahead as far as the U.S. stock market indices are concerned?
Well, we are at a critical point. We have rallied almost exactly as we said. Even Bitcoin has rallied up to this point, but both markets have stalled, and they're at a place, and we're leaning towards the upside breakout. But if stocks can break out to a substantial new high here in the near term, then they should continue to rally towards our target of 10,000 on the NASDAQ. If you get that high, and maybe as high as 33,000 the Dow, that would be what we call the final blow-off rally in the bubble that started in 2009 with all this endless stimulus and money printing. And then, there's only one place to go after that if we see that strong a move, and that's down. And we also always warn people, because I've looked at bubbles over the last century, especially in stocks, and the first crash after a bubble like this is usually 40-some% in the first 2.5 months. So when it does finally come, it whacks really hard. So it's better to get out a little early than late, but I still think the momentum looks basically more to the upside into early next year, and then it's time to watch out. If you see NASDAQ anywhere near 10,000, it is time to sell.
So, Harry, when you look at the political pressure on the Fed to go back to more easy money policies, reducing interest rates. In fact, I think that the consensus is we'll see another quarter-point rate cut here in the near future. I guess I'd like your take on that. Will that, again, stimulate the market, or have we shot all those bullets as far as the Fed's policy is concerned?
Well, there's always more bullets, but they are, there is diminishing returns. I mean, they have raised rates, and they're starting to lower them. They can lower them back to zero. They can buy more bonds, although that's really diminishing returns. I think the thing that Trump has in his arsenal is more what he's talked about not too far ago, about doing a property, a payroll tax, Social Security tax, payroll tax holiday for households, not for businesses. They've already gotten a big tax. That would be, sending. That's like sending money to the public without having to print it and send checks. It's just an easy way to people to save money short term, and that would probably be the best thing to stimulate. But again, how long can you keep having very low interest rates and all this stimulus until everybody's refinanced their mortgage, everybody's traded up to a better house or bought a house that was on the fence or bought a better car? And a lot of people have done that. Car dealers have been one of the biggest beneficiaries to all this quantitative easing. We used to see that people would spend the most money on cars about age 54. Now it's 63. So people, as they get older in retirement, are just saying, well, gosh, with low interest rates and less money to have to spend on my kids in college or grandkids because of student loans, well, we'll just buy a Lexus, So, but how long before that wears out? And you got to notice here, we keep knocking on the door saying this, how can economists not notice that with unprecedented money printing and free money thrown in the economy and tax cuts for businesses and everything else, we keep returning almost instantly to 2% growth, and there'll be a period when we don't have that. The economy is weak in demographic trends. We called the top in momentum in late 2007, 20 years before it happened, just on predictable baby boom spending. We've been living off of free money and stimulus, unbelievable stimulus, and Japan makes us look like nothing. And Europe has already turned around in stimulus. So everybody's stimulating strong like Japan or looking to re-gear like Europe and the U.S. So they're going to keep stimulating. And any sign of weakness, but the question is, when does it just not matter, or when does the stimulus just come too late? And remember, that first crash, when the market finally smells weakness and thinks it's over, it comes very fast. So again, there's still momentum because the markets see, well, gosh, China or Trump, somebody's going to make a deal on trade here. I don't know about that one, but yes, more stimulus is coming, and that's what the markets are liking. A market on crack, as I call it, wants more crack. The market almost doesn't mind hearing weakening news because it means, oh, well, that means they're going to have to print more money, and that money ends up in the stock market because there's nowhere else to go with bond yields so low. So that's the game. Constant stimulus, zero interest rates, adjusted for inflation and risk, endless money printing to stimulate, the system. And it mainly helps the top 1 to 10%. The everyday person gets very little, and eventually this whole thing blows. And when it does, it just can't be pretty. When you kick the can down the road, so all this policy is going to backfire, but it always works at least a little in the short term, but it's working less and less. So I think this policy is going to fail, but they have no other option. I mean, as soon as they cave, if they announce no more stimulus like we started to do, the markets will start to cave and the economy will cave. That's what's going to happen. You don't take more crack, you come down and you go into detox. That's where we're at.
So, Harry, you had mentioned the boomer spending and demographics, and for our listeners maybe who aren't familiar with your work, can you just talk briefly about the correlation between demographics and some of the economic forecasting that you do?
Yeah. I mean, basically, back in the 80s, when I got this from consulting to New Ventures. After consulting to Fortune 100, I decided New Ventures more interesting because they're creating the future. So I just learned from going to these New Ventures who were the first to pick up on the new young baby boomers, the massive wave coming. I just discovered all types of new demographic insights and developed my own methodology. So we've been using that. I predicted in the late 80s when I first came up with spending wave that the U.S. and Europe would see the best decade in history in the 90s, while Japan would see its greatest fall. Now, you don't get those two damn things right by accident because they're opposite sounding. But that's what the demographic said. Japan's at the peak of their bubble in real estate and stocks. Their baby boom spending is their peak, and they're going down. We're saying something very similar for China now. China's demographics have peaked. Their urbanization, which is powerful, has not, but they've greatly overbuilt that. So I see China going to be hit the worst in this bubble burst, and they're the greatest driver of the bubble outside of all this central bank stimulus from developed countries. So demographics is this secret weapon we've had for decades, but in the last decade, I've developed a very powerful technology cycle indicator that is also as important or more, and it's driving urbanization around the world past the developed countries into the emerging world, and that's the biggest trend in the world. And that technology cycle is saying we are right into a super bubble on a 90-year lag from the 1929 peak, and so these stimulus policies are playing into this technology and what I call super bubble cycle that comes every 90 years. The technology cycle comes every 45. So we basically track demographic cycles, technology cycles, that's 45 years, geopolitical cycles, more like 35 years up and down. All of our key cycles are bottoming together in the next 2 to 3 years, which means it's going to be the hardest time for government's stimulus to work and the most likely time to see this final great crash to end what started in 2008. 2008 was looking exactly like 1930, as our indicators would have suggested. It's just this time around, central banks decided we will pull out the kitchen sink and the bazookas and the tanks and the A-bombs and do anything to keep this downturn from happening because nobody wants a Great Depression. And what they're going to get is a bigger one at the end of the cycle instead of the big one at the beginning like we had in the early 30s. The Great Depression lasted over a decade off and on. The big crash happened first, aftershock next. 2008-9 is going to look like the aftershock, and the big crash is going to happen 2020 to 22 by our indicators. So, I mean, they're just putting off the inevitable, and you can't keep a bubble going forever. Nobody's ever done it. No bubble has ever not burst, and no bubble has ever had a soft landing when it finally burst. That's what history says. This is the biggest bubble ever, but even this mighty bubble will go down. You don't want to be sitting there when it does.
Well, if you're just joining us, we're chatting today with Mr. Harry Dent. Harry's most recent book is 0 Hour, and if you're not yet a subscriber to his free newsletter, go check it out at harrydent.com. And Harry, as you were talking, and we've got about 4 minutes left in this segment, you said that we're really looking at something that's going to be greater in magnitude than the Great Depression. Those are obviously very scary words, and that's a scary prediction. What would you advise listeners who are thinking about retiring or trying to protect a nest egg? What kind of advice would you have for them?
Okay, first of all, I would say this will be as great or nearly as great. The difference between this and the Great Depression was we have emerging countries on much stronger demographic cycles that give some cushion, not so much China, but the rest of the emerging world. But still, now that we've blown this bubble so far, I do expect an 80% plus stock crash, and that's more like what we saw in the Great Depression. But the important insight for investors, and especially retirees, all financial assets, real estate, stocks, commodities, and even gold go down, go out of their bubbles into a reset, come down to reality, that what holds up are two things. Well, actually three. High-quality bonds like long-term treasury bonds and AAA corporates, because they're the safe haven. They are safe. Those are the bonds that aren't going to default. All other bonds are going to have risk of that. So they hold their value. They pay you interest, 2, maybe 3% if you're lucky, maybe 4% on a AAA corporate, which gives you cash and cash flow. They hold up. In the 30s, those bonds doubled in value while everything else crashed. Cash flow positive, like apartment rentals, real estate, that holds up well and gives you cash flow when cash is highly valued. And simply selling risk assets and creating a pile of cash and high-quality bonds that are more liquid. When things crash, 2 to 3 years later, you can buy stocks, companies, gold, commodities, real estate. It may take a little longer to get the good values on real estate at what we call the sale of a lifetime. So the issue is, if you wait and say, well, I'll wait till it's clear. Well, what happens when that first 40, 50% crash happens in 2 to 3 months? And then you panic, and then, it's too late. So the key is you've got to preserve your capital near the top of such an unprecedented bubble and say, look, even if I don't quite get the top, if I get out a little early, like Baron Rothschild said was the secret to his wealth in the 1800s, you preserve your wealth, and that wealth, that money is worth way more when everything drops. And then, like Joseph Kennedy, you buy stuff at the bottom, So that's the trick. Just get more conservative, whether you just lean from higher quality bonds from lower quality. If you have to stay in some stock allocations in your 401k, we'll go from the tech stocks and high growth stocks to the utilities and the consumer staples and stuff if you have to choose some stocks. And commodities are still going to go down further. Gold's going to go down again, even though it's rallying. You just get safer, and then you start buying in 2022 forward in, what we call the sale of a lifetime. You will only see a crash of this magnitude once in a lifetime, if that, and you'll only see the opportunity to buy everything at bargain prices. But only the people that preserve their capital will have that opportunity. If you lose 80% on your stocks, lose 50% on your real estate with debt against it, which means you can be underwater, and so on. So you're not going to have any money to take advantage of the sale of a lifetime. You're going to be kicking yourself forever.
Well, that is perfect timing. The bad news is that's the end of this segment with Harry Dent. However, he will be back in the next segment when RLA Radio returns. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I have the pleasure of chatting today with Mr. Harry Dent. Harry is the best-selling author of the book 0 Hour, and if you're not yet a subscriber to his free newsletter, I would encourage you to check it out at harrydent.com. And Harry, we talked in the last segment a bit about negative interest rates, and I can only describe negative interest rates as lunacy. I mean, who on earth would make an investment only to get back less than you invested at a certain point down the road? How would you explain that these things can even exist?
Well, it's inconvenient for people to hold cash somewhere or physical gold or whatever they're looking at protecting themselves. So people will tolerate that some, even though it is ridiculous. What it is a symptom of, or an example of, governments are just desperate to do anything to stimulate the economy. What happens in a bubble boom, like we already saw, especially from 1995 into 2007, financial assets get overvalued. Debt grows much faster than normal because there was low interest rates and strong growth promoting that. We call it the fall bubble boom season, like happened in the early 1900s and the roaring 20s and repeats 80 years later in this recent boom. People overborrow. There's excess capacity in business, overinvestment. Financial assets get bid up to ridiculous values so that you could never make money if you bought them at those values, whether you're an older investor or a younger investor. And so the bubbles have to burst and the debt has to deleverage. This is a cycle, again, only happens every other generation, about every 80 to 90 years, and then it's very devastating. Negative interest rates are a key part of this. Never before have interest rates gone negative. Never before have government, they printed some money in the Great Depression to cushion the banking system, but nothing like that. They printed 3 times as much compared to the economy, and they're still printing. So this is a desperate effort that's gone to extremes. It means older investors saving for retirement can't afford to get into this type of safe bonds with guaranteed reasonable interest to fund their retirement that they should do. So people have more stocks than they should and more risky bonds and junk bonds. They're going to get clobbered on that just when they need the money most when this reset happens. So negative interest rates are stupid and desperate. This will not look good from history's perspective. How could grown, educated men and bankers, and especially Federal Reserve Chairman, who's supposed to be long range, smart thinkers, conservative, have just blown this sort of, this is like taking crack every day, and every time you come down, you just take double the dose. They keep upping the dose of stimulus, keep pushing interest rates, now not just free money adjusted inflation, like you say, negative interest rates, and not just short-term, long-term bonds, more and more are negative interest rates. This is perverting the economy. It only causes excess, bigger bubbles in financial assets, more overinvestment in capacity in businesses, and that all takes a bigger deleveraging and shakeout to come back down to reality. So you only create a bigger bust down the road. Because last I looked through all of history and all of religious history and human evolution, you don't get something for nothing, damn it. And that's what basically government policies are doing. We'll just keep printing more money, cutting more taxes. Next thing, they'll be sending money to consumers, and you have to spend it by the election. I can see them sending a debit card to every household and saying, but it expires, 2 weeks before the election, so get Donald Trump reelected. That's how stupid this is.
Well, Harry, as you mentioned Donald Trump, you mentioned in the last segment we were talking that one of the cycles that you track is a geopolitical cycle. Can you expand on that? And based on what you've learned from your geopolitical cycle, talk a little bit about 2020 and what politics might look like here in the U.S. and around the world.
Well, I think this geopolitical cycle is going to be it is actually at its worst early next year. It's the only cycle that is bottoming near term. Our other 3 cycles out of 4 all bottom somewhere between 2022 and 23, and one of them doesn't bottom until 2032. But it's the one cycle that should be about to turn up. I think this public shootings and stuff, in other words, we've gone from the terrorists in 2001 being the radical Muslims and type of terrorists. Now we've gone towards the worst terrorists are the homegrown white supremacists and stuff. Everybody's getting sick of this stuff, and I think it's basically, you're finally going to see some action and stuff. So I think this is the first thing to possibly turn around, but it's still a trigger along with these other cycles. But so I think the surprise is that we're not going to see World War III. We're not going to see worse and worse terrorism, but it is still getting worse now. And so it's going to be no help. And once this bubble starts to crash, that will not be as relevant. And of course, on the flip side, you're going to get a lot of unrest. I am not just in Puerto Rico because the cost of living are lower and to be closer to my vacation house, and I am getting some tax advantages, even though I didn't move here at first for that. I'm here because they've been through 12 years of recession and the worst hurricane in their history, and there's been very little civil unrest. If we had anything like what Puerto Rico's experienced in the U.S. and what we're seeing in Trump America with blue and red is polarized as they were at the beginning of the Civil War, we'd have much worse. So I do think that the downturn itself is going to cause a lot of civil unrest. I don't think the international geopolitical cycle is going to create the havoc it has since 9/11. By the way, Dennis, I only found that cycle following my demographics when the final boom from 2000 to 2007, which we forecast way in advance and right at when it started, was not as strong as I expected on demographic factors alone. That's because the geopolitical cycle turned negative in 2001, and stocks have half the valuations in the bad geopolitical cycle. So I had to realize, gosh, stocks are not doing as good as they did in the 90s boom as I thought they would in the final surge. And what's the reason? I finally found, I found this geopolitical cycle. And I tell you, it's like a clock, 17 to 18 years positive, like 82 into 2000, and then 17, 18 years negative, like 2001 into current times. But this is the one cycle that may start to work to our advantage, but the other cycles are still overwhelmingly negative for the next 2 to 3 years, and that's when I think the worst of this crash is going to happen.
So what's your take on how the 2020 presidential election might play out, if you have an opinion?
Well, I do, and it's my two scenarios. Now, naturally, this bubble looks like it's in its final phase, and it should peak early next year with one more rally. It might be a correction, then a rally, or this rally just continues and we can break up a little higher, which still looks slightly more likely. But it would naturally peak and go down. But Donald Trump is going to do everything. He already sees the bond markets are seeing weakening globally. Leading indicators are seeing that everything's pointing towards a recession hitting in 2020. And no president gets reelected in a stock crash in recession, including him now that he's been in long enough to be clearly blamed for it. So the wild card is that Trump pulls some very strong one more stimulus that just gets the economy, keeps it from going down in most of 2020, and then it goes down after the election. He may or may still not get reelected in that scenario because he's also coming apart at the seams in some ways. But that is 2020 is going to be a tipping point one way or the other. Question is, does this thing peak at the beginning of the year more or towards the end? And that is still a question. I still favor the peak coming earlier, and that would mean he does not get reelected. The markets and the economy, if they go down, will very likely decide the election against the Republicans and for the Democrats.
People tend to vote their pocketbook, and the state of the economy on election day usually predicts the outcome. So absolutely true. So Harry, we've got just a few minutes left. Let's talk a little bit about pensions, because I think one of the stories that goes underreported anyway, in my view, is the effect that all these low interest rates and negative interest rates are having on pension plans. Can you comment?
Oh my God, it's death. These people, I mean, again, they're like life insurance companies. They're supposed to invest conservative, especially when their pensioners are getting closer to retirement, just like retirees should invest more conservatively. And then, their plans have always, we need, with these slightly more conservative allocated, we need to make 7-8% a year. Well, that's impossible with these super low interest rates without buying junk bonds and without buying high dividend stocks. So it is very hard for them to meet their targets, and to the degree they do, they are having to get riskier than they should, which is going to backfire on them. And this is one of a lot of the triggers I see for the next trend. The debt since 2007 and 8 in the last bubble has largely come because of low-cost money printed by the developed countries and central banks. Emerging countries caught up, and they borrowed themselves silly. Now, they're the ones that are going to have the riskiest debt and default, and these pension plans, municipalities and stuff, are going to have big problems, and they're going to have to start defaulting and restructuring, and that's going to hurt their beneficiaries and therefore consumers. And I'm sitting in Puerto Rico. They've already gone through this. They're in a 12-year recession because the pharma tax incentives phased out, but then their bonds, their tax-exempt bonds, which a lot of local people bought here, not just the hedge funds and stuff, those have been defaulting, and that's hurting consumers. Little old ladies in Puerto Rico are hurting, and they're spending less. So they've been in a 12-year recession. So this is another reason that you just can't keep stimulating your way out of this. The very negative interest rates are causing bank profits to keep going down. So bank stocks keep cratering, even with the recovery. And it's causing these poor pension plans to be even more under pressure than the excessive aging of the baby boom generation is already putting on. So there's no way to win this battle. The fundamental trends are bad. The only thing keeping us going is crack-like stimulus, and that will fail as all artificial drugs fail, and we will detox and deleverage, and it will be nasty. I'm just trying to be the lone wolf out there that warns people about this. I get a lot of flack for this, Dennis, as you know. But somebody's got to say it, because everybody's like, well, if they just keep doing this and blah, 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 and there's one big hedge fund there, we can have a beautiful deleveraging. Never been a beautiful deleveraging in history. End of story.
Well, our guest today has been Mr. Harry Dent. Harry, always so much to talk about with you, but unfortunately the clock says that we have to end it there. I've been chatting with Mr. Harry Dent. His book is 0 Hour. If you'd like to get his free newsletter, you can go to harrydent.com and subscribe. And Harry, thanks for being on the program again. Love to have you back down the road.
Okay, great, Dennis.
I'll be back after these words. This is RLA Radio. I am Dennis Tubbergen. Glad you're listening in today. In the first segment of today's program, I talked about something called the Dow to gold ratio. And I used this ratio to share with you my forecast for stocks and gold. Now, the Dow to gold ratio, just in case you were not listening during the first segment, is calculated quite easily. You simply take the value of the Dow Jones Industrial Average and you divide by the price of gold per ounce. So it's the price of the Dow Jones Industrial Average in dollars divided by the price of gold per ounce in dollars. Currently, the Dow to gold ratio is about 18. Now, the reason that I like to use the Dow to gold ratio is that the U.S. dollar has not had consistent value over time. However, an ounce of gold has always been an ounce of gold, so the value has been consistent. And as gold prices go up in terms of dollars, as they have been significantly this year, what that's really telling us is the purchasing power of the dollar is declining because gold is not inherently worth more now than it was at the beginning of the year in real terms. It still takes the same amount of gold to make a necklace or a ring. It's just that in dollar terms, the value of gold has increased. So to adjust the value of stocks to real terms, I like to take the value of the Dow and divide by gold. Now, in the first segment, I also mentioned there were a couple things driving the stock price up. And 18, incidentally, on the Dow to gold ratio is historically kind of a middle-of-the-road number. Prior to the tech stock bubble crash, that number got up over 40, and at the market bottoms of the Great Depression, at the market bottom in 1980 after the 70s, we saw that ratio go from 2 to 1. And as I mentioned in the first segment, my forecast is for that Dow to gold ratio to reach 1. And there's a lot that has been driving stocks. One, as I mentioned in the first segment, stock buybacks. Companies used the additional cash they had after the 2017 corporate tax cuts to buy back some of their own stock. However, that is slowing down. And as buybacks slow, that means one of the activities that has been driving up stock prices becomes less influential and makes stocks more susceptible to a decline. Second factor is margin debt. And as I mentioned in the first segment, margin debt is debt that an investor incurs to purchase securities, usually stocks. And as long as margin debt keeps going up, what it means is investors are continuing to borrow more money to invest in stocks, and that creates additional demand as well. Now, margin debt is near an all-time high on a nominal basis, and on a real basis adjusted for inflation, margin debt is still below all-time highs. So perhaps there's a little more room here to add margin debt, but I wouldn't count on it. Now, one of Warren Buffett's favorite indicators to gauge stock valuation is not unlike the Dow to gold ratio, although Mr. Buffett notably doesn't comment on gold. Mr. Buffett likes to use market capitalization to gross domestic product. So take the total value of the stock market, total market capitalization, and divide by total economic output. And that tells you, on a relative basis, are stocks inflated? Well, if you go back to just prior to the tech stock crash, back in 2000, the ratio of market cap to economic output was 161%. At the market bottom, after the financial crisis, it dropped to 65%. It is presently back to about 146%. So there's only one time historically that this market capitalization to gross domestic product ratio has been higher, and it's just prior to the tech stock bubble crash. Now, one other thing that I should point out, if you take a look at price-earnings ratios, which is traditionally how someone would value stocks, Robert Shiller has something called a cyclically adjusted price-to-earnings ratio. Basically, when you take a look at the ratios, there's only 3 times in history that this number has exceeded 30, when the price of a stock was 30 times earnings using this cyclically adjusted index. The first time was in 1929. The second time was prior to the tech stock bubble crash, and the third time is now. Well, in 1929 and 2000, the only 2 other times this has exceeded 30, we know what happened. We are there again. Now, let me speak just a little bit about gold in the time I have left. Central bank policies are improving the fundamentals for gold, and I'll be talking about this on the program next week with Alistair McLeod. Money creation via quantitative easing programs worldwide are bullish for tangible assets, gold in particular. Now, Peter Schiff, who's been a past guest here on the program, had this to say this past week about his call for gold reaching $5,000 per ounce. Sounds crazy, doesn't it? Well, Schiff agrees. Here's what he said. Most investors think my $5,000 gold call is crazy. But what's crazier, negative interest rates or $5,000 gold? Last week's guest here on the program, Mr. Michael Pinto of Pinto Portfolio Strategies, said this. He said, when interest rates are up, keeping money in a cash deposit account makes sense. If you had a choice between depositing money in an account yielding 6% interest or buying gold that doesn't yield much, if anything, most investors will choose the deposit account and capture the investment yield. However, if cash accounts and gold are both yielding 0, most investors are going to opt for the tangible asset, gold, rather than keeping assets in a fiat currency. So that's the logic behind my forecast. If you'd like to learn more, we have resources available on our website. You can go to retirementlifestyleadvocates.com. We also talk about this at educational events that we hold around the area. You could go to socialsecuritydinner.com and see when the next event is going to be held. Again, that website, socialsecuritydinner.com. Thanks for listening today. Hope you got something you can use. I'll be back again next week.